In September 2008, the largest bankruptcy in American history sent shockwaves through the global economy. Lehman Brothers collapsed with $639 billion in assets. Within days, global stock markets lost $10 trillion in value. 8 million Americans lost their homes. 9 million lost their jobs. The entire world economy teetered on the edge of complete meltdown. But here's what most people missed while they were sleeping through economics class. This wasn't a natural disaster. This was man-made. Wall Street banks had discovered a magic trick. They figured out how to take loans made to people who couldn't afford them, package them together, and get them rated as safe as government bonds. They called these packages mortgage-backed securities and collateralized debt obligations. And for a while, everyone got rich, until the whole house of cards collapsed. Today, you're going to learn exactly how the smartest people on Wall Street convinced themselves they'd found a way to eliminate risk, and how that delusion nearly destroyed the entire global financial system. This is the story you slept through. But before we dive in, if you're interested in the economic stories that shaped our world while most people weren't paying attention, please hit that like button and subscribe to the channel. Ring the notification bell because we're uncovering financial mysteries that changed everything. Chapter 1. The Setup. The American Dream on Steroids. To understand how the 2008 crisis happened, we need to go back to the late 1990s. The American dream has always centered on homeownership. But for decades, getting a mortgage was hard. Banks were careful. They wanted to see your tax returns, verify your income, and make sure you had money for a down payment. This made sense because banks kept these loans on their own books. If you defaulted, they lost money. But in the 1990s, something changed. Banks discovered they could bundle thousands of mortgages together and sell them to investors as mortgage-backed securities, or MBS. Think of it like this. Instead of holding on to one mortgage and waiting 30 years to get paid back, banks could make 1,000 mortgages, bundle them together, and sell them immediately. This process is called securitization. Here's where it gets interesting. Once banks could sell mortgages immediately, they stopped caring whether borrowers could actually repay them. Why would they? The risk was being passed along to whoever bought the mortgage-backed securities. This created what economists call a moral hazard. The people making decisions didn't face the consequences of bad decisions. Investment banks like Lehman Brothers, Bear Stearns, and Merrill Lynch saw an opportunity. They started buying these bundles of mortgages and creating even more complex investments called collateralized debt obligations, or CDOs. A CDO takes various mortgage-backed securities, slices them into different risk levels, called tranches, and sells them to investors. The top tranches were supposed to be super safe. The bottom tranches were riskier, but paid higher returns. Rating agencies like Moody's, Standard & Poor's, and Fitch were supposed to evaluate how risky these investments were. But here's the problem. The investment banks creating CDOs were paying the rating agencies to rate them. It's like paying a restaurant critic to review your restaurant. The agencies had every incentive to give high ratings, and they did. Stamped AA ratings, the highest possible safety rating, on investments filled with mortgages made to people with terrible credit. Meanwhile, regular mortgage lenders started getting creative, invented new types of loans to get more people into homes. Adjustable rate mortgages started with low interest rates that would jump higher after a few years. Interest-only loans let you pay just the interest for a while, not touching the principal. Some loans required no down payment. Some required no proof of income. These became known as NINA loans, short for no income, no assets. People called them liar loans because borrowers could literally lie about their income and get approved. By 2006, subprime mortgages, loans made to people with poor credit, made up 20% of all new mortgages. Mortgage brokers earned commissions for every loan they sold, so they had incentive to approve anyone and everyone. Some borrowers were taking out mortgages 5 or 6 times larger than their annual income. Housing prices kept rising, so everyone assumed even if someone couldn't make payments, they could just sell the house for a profit. Chapter 2. The Build. When everyone thought they were geniuses. From 2001 to 2006, housing prices increased by over 85% nationally. In some markets like Las Vegas and Phoenix, prices more than doubled. This created what economists call a bubble. People weren't buying homes to live in. They were buying them as investments, planning to flip them for quick profits. Wall Street couldn't get enough mortgages to bundle and sell. Investment banks started urging lenders to make more loans to feed their securitization machines. Remember, banks could originate a mortgage on Monday, sell it to an investment bank on Tuesday, and use that money to make new mortgages on Wednesday. It was a conveyor belt of debt. The financial innovation didn't stop with CDOs. Wall Street created synthetic CDOs, which were essentially bets on whether regular CDOs would fail or succeed. Then they created CDOs made up of other CDOs, called CDO squared. The complexity became so extreme that even the people creating these products didn't fully understand the risks. Leverage amplified everything. Investment banks were borrowing $30 or $40 for every dollar they actually had. This is called leverage, and it works great when things go up. If you put down $1 and borrow $30, a small gain makes you rich. But it also means a small loss wipes you out completely. By 2007, the total value of mortgage-backed securities and related products exceeded the entire gross domestic product of the United States. The entire global financial system had become dependent on American homeowners making their mortgage payments. Warning signs appeared as early as 2006. Housing prices started flattening. Foreclosure rates began ticking up, particularly on subprime mortgages. In early 2007, several subprime lenders went bankrupt. But most people on Wall Street weren't worried. They believed they'd engineered a system that had eliminated risk through diversification and mathematical models. Credit default swaps added another layer of complexity. These were essentially insurance policies against CDOs failing. Companies like AIG sold credit default swaps, collecting premiums and promising to pay out if mortgage-backed securities went bad. But AIG didn't set aside enough money to cover potential losses, assumed the housing market would never crash nationwide. That had never happened in modern American history. Chapter 3. The Breaking Point, the day Wall Street realized. In March 2008, Bear Stearns, one of the oldest investment banks on Wall Street, collapsed. Bear Stearns had been heavily invested in mortgage-backed securities and CDOs. As mortgage defaults increased, the value of these investments plummeted. Bear Stearns couldn't cover its debts. In a single weekend, the Federal Reserve arranged for J.P. Morgan Chase to buy Bear Stearns for $2 per share. Just a year earlier, Bear Stearns stock had traded at $170 per share. The Bear Stearns collapse sent shockwaves through the financial world. If Bear Stearns could fail, what about other investment banks? Lehman Brothers was next in line. Lehman had $639 billion in assets and $619 billion in debt. They'd made massive bets on real estate and mortgage-backed securities. Through the summer of 2008, Lehman desperately sought a buyer or government bailout. Other banks looked at Lehman's books and ran away. The toxic assets, mortgages that would never be repaid, were everywhere. Nobody wanted to touch them. On September 15, 2008, Lehman Brothers filed for bankruptcy. It was the largest bankruptcy filing in American history. 26,000 employees lost their jobs. But the real shock was what happened next. Financial markets froze. Banks stopped lending to each other because nobody knew which bank would fail next. If you couldn't trust other banks, you couldn't do business. Credit markets, the circulatory system of the global economy, stopped functioning. The stock market crashed. The Dow Jones Industrial Average, which measures the stock prices of 30 large American companies, dropped 500 points the day Lehman failed. Within days, it had fallen over 2,000 points. The next day, the Federal Reserve had to rescue AIG, the insurance giant, with an $85 billion loan. AIG had sold credit default swaps to everyone, promising to cover losses on mortgage-backed securities. When those securities failed, AIG owed more money than it had. If AIG collapsed, it would take down every major bank that had bought insurance from them. Chapter 4. The Fallout, when Main Street paid for Wall Street. The crisis quickly spread from Wall Street to Main Street. Banks stopped making loans. If you wanted to buy a car, start a business, or get a mortgage, forget it. Without credit, economic activity ground to a halt. Companies couldn't borrow money to make payroll or buy inventory. Unemployment skyrocketed. From 2008 to 2009, nearly 9 million Americans lost their jobs. The unemployment rate hit 10%. Housing prices collapsed. By early 2009, average home prices had fallen over 20% from their peak. But in hard-hit areas like Las Vegas, Phoenix, and parts of Florida and California, Prices dropped 50% or more. Millions of homeowners found themselves underwater, meaning they owed more on their mortgages than their homes were worth. Foreclosures devastated communities. 8 million Americans lost their homes between 2007 and 2013. Entire neighborhoods turned into ghost towns, with rows of abandoned houses. Property values collapsed, which meant less tax revenue for cities and towns. Schools and public services suffered. The crisis went global. European banks had bought billions of dollars worth of American mortgage-backed securities. When those investments turned toxic, European banks failed. Iceland's entire banking system collapsed. Greece, Spain, Ireland, and Portugal fell into severe economic crisis. The global financial system was interconnected, and the collapse in America spread like a virus. On October 3, 2008, Congress passed the Troubled Asset Relief Program, known as TARP. This was a $700 billion bailout package designed to prevent complete economic collapse. The government used this money to buy toxic assets from banks and inject capital into failing financial institutions. The Federal Reserve took unprecedented action. They cut interest rates to nearly zero. They implemented quantitative easing, which means they created new money and used it to buy government bonds and mortgage-backed securities. Over the next several years, the Fed pumped trillions of dollars into the financial system to keep it from collapsing. Not everyone got bailed out. Lehman Brothers failed. Washington Mutual, the largest savings and loan in America, failed and was sold to J.P. Morgan Chase. Wachovia was absorbed by Wells. Fargo Merrill Lynch was purchased by Bank of America to avoid failure. Thousands of smaller banks failed. Chapter 5. The Aftermath. A different world emerged. The Great Recession, as it became known, officially lasted from December 2007 to June 2009, but the recovery took much longer. It took until 2014 for employment to return to pre-crisis levels. Many people who lost jobs never recovered their previous income. Young people graduating during the recession suffered wage effects that lasted for decades. The government response created massive controversy. Many Americans were furious that Wall Street got bailed out while regular people lost their homes. The phrase "too big to fail" entered the national vocabulary. It referred to banks so large and interconnected that their failure would destroy the entire economy, forcing the government to rescue them. In 2010, Congress passed the Dodd-Frank Act, the most significant financial regulation since the Great Depression. The law created new oversight agencies, required banks to hold more capital as a cushion against losses, and implemented stress tests to ensure banks could survive another crisis. It also created the Consumer Financial Protection Bureau to protect borrowers from predatory lending. The crisis destroyed trust in financial institutions. A 2009 poll found that only 25% of Americans trusted banks, down from 53% before the crisis. This distrust contributed to political movements like Occupy Wall Street and influenced elections for years. The crisis accelerated wealth inequality. While the stock market eventually recovered, people who had to sell investments during the crash or lost their homes never recovered. Meanwhile, wealthy investors who could afford to buy during the crash made enormous profits. The wealth gap between rich and poor Americans grew significantly wider. Interestingly, very few people went to jail. Despite widespread fraud in mortgage lending and securities creation, most executives faced no criminal charges. Some paid fines, but those fines came from their companies, not their personal wealth. This lack of accountability fueled public anger and cynicism about the justice system. The crisis changed how we think about financial markets. The idea that markets always self-correct and regulation is unnecessary was thoroughly discredited. The mathematical models that said housing prices couldn't fall nationwide were proven wrong. It's the efficient market hypothesis, which said markets always price assets correctly, was revealed to have serious limitations. Chapter 6. The Human Lesson. What you need to know today. The 2008 financial crisis teaches us several crucial lessons that remain relevant today. First, when something seems too good to be true, it probably is. Wall Street convinced itself that it had eliminated risk through financial engineering. Investment banks believed their mathematical models and computer algorithms had created a perpetual money machine. But risk doesn't disappear. It just moves around and sometimes hides until it explodes. The more people insisted housing prices could never fall nationwide, the more certain it became that they would. Second, incentives matter enormously. Mortgage brokers who earned commissions for every loan had incentive to approve bad loans. Rating agencies paid by investment banks had incentive to give good ratings. CEOs compensated with stock options had incentive to take huge risks for short-term gains. Bank executives knew they'd collect massive bonuses if their bets paid off, but taxpayers would absorb the losses if things went wrong. When incentives are misaligned with outcomes, disasters happen. This applies beyond finance. Anytime someone profits from a decision but doesn't bear the consequences of failure, watch out. Third, complexity is dangerous. The CDOs and synthetic CDOs were so complicated that even experts didn't fully understand them. When questioned, Wall Street executives would explain these products using technical jargon and complex mathematics. But complexity often serves to hide problems rather than solve them. In finance and in life, when you can't explain something simply, that's a warning sign. Warren Buffett, one of the world's most successful investors, has a rule: never invest in something you don't understand. The people who lost the most in 2008 were those who bought investments they couldn't explain. Fourth, leverage amplifies everything. Borrowing money to invest can make you rich, but it can also destroy you. Investment banks were borrowing $30 or $40 for every dollar they actually owned. This meant a small decline in asset values wiped them out completely. This applies to personal finance too. Taking on too much debt based on optimistic assumptions about the future is incredibly risky. Many homeowners in 2008 bought houses assuming their income would rise, housing prices would increase, and they could refinance easily. When those assumptions proved wrong, they lost everything. Fifth, diversification isn't magic. Wall Street believed that bundling thousands of mortgages together eliminated risk because they were diversified across different borrowers and locations. But when the entire housing market crashed, diversification didn't help. All the mortgages failed together. This taught us about correlated risk. When everything is connected to the same underlying factor, diversification provides false security. 6. Trust but verify. Homeowners trusted that mortgage brokers were offering them suitable loans. Investors trusted that rating agencies were accurately assessing risk. Regulators trusted that banks were managing risk responsibly. All of these trust relationships broke down. The lesson isn't to trust nobody, but rather to verify claims independently. Read the documents. Ask questions. If someone pressures you to sign quickly without reading, that's a red flag. Here's what to watch for today. When housing prices rise rapidly and people start calling it a new paradigm where old rules don't apply, be skeptical. Every bubble in history has been accompanied by claims that this time is different. When banks aggressively market loans with teaser rates, minimal requirements, or promises that sound too good to be true, be cautious. When everyone around you is getting rich from some investment and urging you to join in, that's often a sign of a bubble nearing its peak. Finally, remember that financial crises follow patterns. There's always a period of innovation where new financial products emerge. Then there's expansion where everyone makes money and caution is dismissed as pessimism. Warning signs appear but are ignored. Then comes the crash, then the crisis, then reform, and slowly memories fade, and the cycle begins again. We saw this pattern in the 1920s, the 1980s savings and loan crisis, the 2000 dot-com bubble, and the 2008 financial crisis. The 2008 financial crisis wasn't an accident or an act of God. It was the predictable result of perverse incentives, excessive leverage, misplaced trust, and willful ignorance of risk. By understanding what happened and why, you can avoid making similar mistakes in your own financial life and recognize the warning signs when the next crisis approaches, because there will be a next crisis. There always is. If stories like this, where we uncover the economic events that shaped our world while most people weren't paying attention, fascinate you, please like this video and subscribe to the channel, because we're just getting started with these financial educational mysteries.